Hello, everybody. This is Terry Laundrie. We're looking at the long T-theory 40-year cycle. There's an even longer cycle contained in this chart, which is roughly double of 40 years. Let's first look at the 40-year cycle, and then we'll consider the longer one in the channels. At the bottom scale, you see we're working in decades here, running about 200 years of history. And at the top, we have the Dow Jones Industrial Average, or its predecessors, going back into the early 1800s. And we have a green moving average, which is a 200-month moving average. And we have a set of channels, constant width, red along the top, green along the bottom. And down below, we have a proprietary oscillator, which is measuring the momentum of the price in that channel, and the whole idea is to come up with some idea of cycles. You notice the blue oscillator going from an overbought to an oversold condition tends to run in 40-year segments. That was my primary discovery when I set this chart up. You have the high in the 1830-40 time period. You get one low in the going into 1850. There's another one just after that, and that occurs about 20 years later. And then another 20 years, you're back to the completed cycle for a high. Then you go another 20 years, and you're back at the low around 1900. Then you go up to a high zone in the going into the 29 peak. You have a low zone in the period right after the crash, and then in the next decade. A high in the late 60s, a low in the 70s, and 74-82 low. And then we have another 20 years from that, we get the high. And you'll notice that my oscillator peaked at the year 2000, roughly the same level as at the 1929 peak. And the consequences of that overbought nature is what the whole concept of the 40-year cycle is about. Now, when you look at the channels, you notice there's a slightly different cyclical tendency, which is about twice as long. It varies between 80 and 90 years. And you can see that by drawing these parallel channels. You can see there's a high in the coming into 1840, 1929 peak, and then you have a peak if you try to draw these channels in a sideways in a parallel fashion, which would be around 2000, and a failure to get quite that high in '07. And then on the bottom, if you keep constant width, you tend to pick up the lows in the 1850, then the depression and in the after the 1929 crash. And if you take that cyclical tendency to be repetitive on an 80 to 90 year basis, then you would expect that there's another depression, and that depression would occur approximately where the green line and the Dow Jones Industrial Average intercept sometime in the future. The intercept point would be in the year 2020 in all probability. And you'll notice that at the bottom of the chart, what I've done is I've put in the crisis opportunities for each of these widely separated lows, where you can pick up things, real estate, stocks, probably anything, in a crisis at a very low level. The trick, of course, is that you have the money, and that's another story. But if you're looking for a crisis opportunity in which you could make the one trade of significance in an 80-year perspective, then you would look for it sometime getting closer towards the 2020 time period. And other discussions, we look at we'll look at some other opportunities to make money going down. But for the near term, this is the whole picture for the crisis opportunity and a general view of the long cycles. Thank you.